Thanks everybody for coming. Thank you, Vince, for having us. Vince reached out a couple weeks ago and asked us to form a panel, fireside chat, sort of about the state of the microcap industry. My name is David Briones. I'm the founder and managing partner at Brio Financial. We are an outsourced CFO, outsourced financial advisory firm. We represent about 45 Nasdaq, NYSE listed publicly traded companies, another 50 or so SPACs, and we've got about a dozen privates that we're doing IPO readiness.
Oh, thank you. Appreciate that. Lawrence Mendelitza, I'm a partner at Lukoski Brookman LLP. We're a corporate securities finance boutique representing companies in all stages from startup through IPO direct to senior exchanges. Currently represent about 55 public companies, probably double that in private companies and more going public or raising capital. Do everything from soup to nuts from a company's life cycle. From a transactional standpoint, including M&A, lending, and capital formation, capital raising in all different stages. And we're growing, started under this banner 14 years ago with 4 people. We have 70 attorneys plus now, expect to be over 100 by next quarter.
Jonathan Gazdak. I started and run Alexander Capital, two of the speakers that were here earlier. Took them public or other companies of theirs public. Boutique investment bank. We've done hundreds of IPOs, secondaries, follow-ons. One thing you'll hear about me, maybe that's why I'm on this panel, don't know, is I speak directly, speak the truth, and open to have a very engaging dialogue with what's going on in the market and everything like that. Both of these guys are great.
Thank you. Lawrence, why don't you give just a general update of what's going on in the industry right now from a legal perspective?
Sure. So there's been a lot of things that have happened this year. So if we're gonna just narrow the focus a little bit in the towards the microcap and small cap space, right, which I consider to be really 300 million and below is the microcap space, and that's sort of the space that we are hyper focused in. There's been a tremendous sort of shift over the last 6 months, obviously into crypto being a new thing, or from a regulatory perspective, being accepted by the exchanges, and you sort of saw the proliferation of the DAT deal, and that's an asset treasury strategy play from a lot of microcaps. And there's a lot of things to discuss there, but I think in general, ultimately what you've seen, frankly, in the microcap space is a tremendous amount more liquidity, right? I think ultimately there's a lot more investor eyeballs that have come into the microcap space, whether it's through growth companies and looking just for high yield opportunities, whether it's they came in because they were part of a crypto transaction and then stayed and continued to invest. But rising tide lifts all boats, right? So the microcap has seen tremendous growth in the last 12 months. There's been a lot more deals in the space, definitely on the secondary side. I think there has not been what everybody was hoping this year, which was bulge bracket deals, right, are still not being seen, right? Ultimately, you don't have these large IPOs. There's been a few, right? Bullish and some others have gone and have been successful, but you're really starting to see, at least on our side, we've seen some really large asset managers come and play in the microcap space, right? We've done RDs in the last 6 months with Blackstone and Citadel and Jane Street, right? So this is a few years ago. You would not have seen that in microcap companies. And so I think there's been definitely a shift in focus, and people are looking for product and a place to deploy capital, and the microcap is still a great space and fairly bullish going into next year.
How about you, Jonathan? What deals are you seeing getting done?
Look, from the investment banking side, I'll echo what Lawrence said. Our role is to play matchmaker, Yenta, whatever you want to say. Rising tides are lifting all businesses. That being said, as the matchmaker, it gets more difficult. I'm looking right here at a manager. As the tide rises, his expectations rise. Liquidity rises. a year ago, I may have been able to say, I can get you $20 million at this, and you would have said yes like that. Now it's like, well, can you get me 30? It's like, so as the tides rise, the expectations by all parties, investors and management teams, rise as well. And that means that more deals are getting done, but not at the velocity that I would hope to see. And I think that the companies and management teams, or management teams and investors, would like to see as well. Right? That's the challenge as the investment banker. Hey, let's get around the table. Let's make sure that cooler heads, and let's make sure that the investors, right, that the public shareholders benefit from this, right? And let's make sure, because us three up here can't speak for all these young people in the room in front of me. You can't see from the camera, but the music will stop, and let's take advantage. Get the capital while it's out there.
Perfect. Lawrence, SEC shutdown, or government shutdown, how's that affecting things? I'm sure that's on everybody's mind.
Yeah, yes, this is,
Why does it have to open?
if I,
That's fair.
Very fair.
If I knew the answer to that, I'd be on Polymarket right now laying a bet. I don't know when it's going to open. We're getting this question a lot. Obviously, there's been some FAQs that have come out, and people are looking for any which way essentially to get their deals done. Right? Obviously, it hasn't affected pipes. It hasn't affected other deals that don't require SEC approval, but those in the microcap space are few and far between, right? So there's been a lot of people that have been, that got caught in the middle of deals, having registration statements on file that still had comments. And so, everybody's sort of looking for, is there a loophole? Is there an end around, right? And so, some of the things that have been discussed include, removing, delaying amendment language from a registration statement, and going effective automatically within 20 days, and whether or not that would be acceptable, right? Every firm and company has its own risk tolerance. The SEC's put out guidance. The exchanges have weighed in recently. And so, I think that you are seeing some issuers that are taking that risk and doing it. It depends on where they are in the life cycle. I think that if you're at 5 comments and below, that the Nasdaq will still take a look at this and, judge you on a case-by-case basis. And let your deal go through. I think the New York Stock Exchange, being a lot more conservative, they've come out and said that, if you still have comments before the SEC, we're not going to let you go through, right? Everybody's kind of left scrambling a little bit. I wish I had a better answer that, by next week, everything's going to be fine. But I think that's out there, and every company has to, talk with their counsel and see if it works for them.
And just to add on that, I completely agree. Our firm is going through this right now. We had an IPO that just got delayed by one of the exchanges, and our registration statement, their effectiveness, they went non-effective. Let's just put it that way. So then it was like, okay, what do we do now? Like, can we just keep going? Like, the SEC's completely agreeing. Alexander Capital and the respective attorneys on the deals, both issuer counsel and underwriter counsel, we're like, look, we're not playing this game, right? There's too much risk there. And we had some large investors, we had some influential people saying, look, while the mice are away, or the rats are away, mice will play. No, we're not doing that. So really be careful. And because when the SEC is back operating, I think, Lawrence, we don't want to be on the other side of, hey, what did you do while what are the odds that they're going to say that? As you said earlier, in this administration, probably low. But you don't want to be on that side, right? So you really got to really still play like the SEC is operating. You don't want to do anything. Why risk it, right? Your IPO can wait another 3 weeks just to make
Hopefully.
sure. Hopefully
Hopefully.
it's 3 weeks. Hopefully
Yeah.
it's
We
3 weeks.
have two in my office right now. I think
yeah,
one
yeah.
of them's with Lawrence and
Look,
you know,
look. But as
updating
Lauren said,
financial
you got to
statements
take
and
your
all
own
of that.
risks.
Yeah.
I'm just
Yeah.
saying that this is maybe not the time to take.
I
those
think,
risks.
I just to probably close the book on this. I think it's a case by case basis, right? Just depends on where you were in the process. I certainly think if you just filed your IPO, to remove the delay language and to try to take that effective is likely not going to work, and I don't think the exchanges will even allow it ultimately. But if you were 99% done, you had 2 comments left. And they weren't necessarily material, and you likely would have gotten through on the next, the next amendment, that there's probably space to play there, right? So, so ultimately, it just depends. I think you have to look at it on a case-by-case basis, and we've certainly done that with multiple companies, whether it's an IPO or a secondary, right? People got to get deals done, and again, you just need to look at it in the face of where are you in the process.
Perfect. So we want to make this intuitive as possible. So just fire away questions for us. Yeah, please.
With that open up lawsuits now, so I'm an investor, right? And you rush the deal through, right? And now I say,
Who's you?
What?
Who rushes the deal?
The issuer.
Everybody.
Push through everybody. Now.
The whole team.
Now my deal comes out when it goes down, and I say, well, it's because you guys rushed it. Maybe the contract should have been handled. Or, just saying, did that cause any issues?
I think we're talking practical versus theoretical, right? I think in a practical world, more than likely not cause any issues. And that's because, look, everybody on the deal teams, from the attorneys, the bankers, everybody's diligent here in getting everything done and having a buttoned up book. It's not like just because the SEC is not around, all of a sudden there's going to be fraud and there's going to be material misstatements and omissions, right? I think everybody's going to do what they need to button up the books and make them, as best as possible, and hopefully not elicit any comments. Ultimately, if the SEC does decide to come back and elicit comments, it could just be in the form of, hey, you should have done this, update it in your next, 10K or 10Q or wherever your next disclosure is, right?
Well,
Say you push it through, it was
Well,
fine,
it's kind of hard.
and they let it go through.
but also,
Yeah, it's kind.
but also keep in mind the
Yeah.
exchanges are still open. So even with the SEC being shut down, the exchanges are still a gatekeeper as well.
They are.
So they're not going to necessarily push through something.
I think he's talking about a face value. If you do get on the exchange, right? The exchange approves you and you're
Right.
good, right? There's no really unwinding a deal, right? Once the investors are out there selling with registered stock, there's nothing that can really be done, right? So you're either looking at you did something wrong and then there's an enforcement action against the company. Is that because you rushed the book through? Probably not in a practical world. That usually means that there were some other errors and other omissions that probably should have been buttoned up regardless of this. So I do think that the risk is minimal, but at the same time, this is an exception to a rule, and the SEC has said proceed with caution. So we don't typically see this. We don't usually live in a world where the SEC is completely shut down. So there's no telling, but I do think that in a practical world that the liability is fairly minimal if everybody does their job correctly.
I have a question. For companies to list, they always come to us as advisory, or we should go Nasdaq and New York Stock Exchange, right? Nasdaq has a bad reputation recently, not being friendly to companies as in New York. Any recommendation on the panel? Do you have a preference on the banking side of stuff and the legal side also, as you seem easier to get deals through on any particular exchanges? And also Nasdaq being a $1 minimum requirement, a lot more strict than the New York Stock Exchange. Would you say that better for companies that work together in the exchange? Or how do you get listed?
Jonathan, you go first.
Look, at the end of the day, both exchanges are great in their own ways. Yes, as a banker, as an advisor, as a management team, you may grumble at either one. Nasdaq has certainly changed their tune over the last 24 months and now ongoing, although I guess with the SEC closed, they can't ratify the new rules, but let's assume the new rules are coming into effect. It's making it more challenging for small cap issuers to list on NASDAQ. That being said, I don't really know if there's a preferred path. It's knowing which exchange needs what information and how that's given to them, right? And the timeliness expectation. If I tell you ladies, if I tell you that it takes 9 months to have a baby, and you don't listen to me, and you show up with 9 women 1 month and expect you to have a baby, it's not going to happen. Nasdaq's going to take you 6 months.
Crazy, man.
What part of that statement is crazy? That you can't have 9 women produce a baby in 1 month, or
different ways. He's got already after party right now.
which way?
Well, I'm a retired guy.
So it's going to take you 6 months at Nasdaq to get through the process. But if your team, if your legal team, your bankers, your advisors are on top of that, that should be all just root. It's not a surprise, and it's not a delay. It's that the professionals are on top of it to help management and the board steer that along the way. So it's actually not a surprise. Now, are there going to be surprises from both exchanges? Yes. Are there going to be government shutdowns? Maybe, but now, yes. But that being said, either path, once a board or a management team decides to go down that, the investment banking group and the respective professionals should be aligned to make that as seamless and as predictable as possible.
I almost feel like the two are almost mirroring each other now over the past year, 2 years. I mean,
Similar.
Yeah, I think.
Ish.
Look, there's no preference from a legal standpoint, certainly, which way we're going. They both have their own standards and their own way of applying and listing, right? So, as Jonathan alluded to, if you meet their listing requirements and you work with them in order to figure out their own process, and both New York Stock Exchange and Nasdaq certainly have completely different processes in terms of listing and different qualitative and quantitative standards, right? So, if you work to get there, there shouldn't be any surprises. Everybody knows how to do it, right? Or to get there if you do it lockstep. But that being said, I think there are some key differences in liquidity, certainly on both exchanges. If you look at the data, right? Certainly, everybody in this room has probably talked to Andy Hall, and he'll show you that all at any chance he'll get, right? So I think that there are definitely probably reasons for certain sectors to be on New York Stock Exchange versus certain sectors to skew towards NASDAQ, right? Usually tech companies go towards NASDAQ, right? Textiles and manufacturing tend to be on New York Stock Exchange. I think over the past, that's sort of eroded in the past, sort of 5-10 years. And I definitely think in the last 24 months, as NASDAQ has sought to change its rules and certainly has shifted its view on the microcap companies, that people have now been looking towards New York as sort of, a new panacea. That's not happening because New York has a completely different process. And it's not just, qualitative standards. They have a committee, and if they don't want you on their exchange, you're not getting on, right? Whereas, NASDAQ, it's more of, if you meet these standards, they're very rigid, you're eventually going to get on. So I don't think that it's certainly not a one-size-fits-all by either stretch, but there's no preference, right? They each have their, pros and cons.
And this might apply to some of this audience or not. The NASDAQ is a condo board. The NYSE is a co-op board in New York. And if the co-op board doesn't want you on it, it doesn't matter what you have, and they won't tell you why. Paul Dorfman and his team.
That's a great way. That's a great way of putting it.
It's just eventually on a condo board you will force yourself on there, but it may take longer. And by the way, should we mention it? There's now maybe going to be a Texas Stock Exchange.
Oh, yeah.
I don't know about that.
It's actually
interesting.
they're up and running. They're up and running.
They don't have an SEC charter. No, I'm just joking. That's not true. Yeah,
They are up and running. We have been in contact with them in the past, especially early going, right? I think I remember one of the first press releases came out, mentioned emerging growth companies. I think their definition of emerging growth and the definition of this room and our definition of the microcap space are two very different things. And so that's kind of what they alluded to when we spoke with them. I'm not sure that they're necessarily looking to challenge Nasdaq and New York Stock Exchange on the microcap side. I think they're looking at companies in the 750 million billion space, which are still
Mid cap and up.
Small cap and mid cap and up companies, ultimately down in the southeast corridor. But so I don't think that there's going to be a huge surge of microcap companies listing on the Texas anytime soon.
Another question on that.
Keep them coming.
So 4 or 5 years ago, capital was free, basically, right? Any deals getting done, basically, on a piece of paper, deals were getting filed. 2, 3 years ago, capital became so expensive, right? Have you seen the tide change back when deals are getting a lot easier to get done? On the capital side, you couldn't even do more than $5 million deal on a small microcap company. Have you seen the tide change a little bit to come back to the company?
I'm going to answer your question. Take the crypto DATs out of the equation. Yes, it's funny. We were talking earlier. The crypto DATs have provided a level of liquidity and buoyancy in the microcap market, whether it's proper or whether it's worthy or whatever it is.
That's brought a lot of visibility.
A lot of visibility. We have seen a ton of deals in the last 2 months, right? RDOs being done, secondaries, overnights, a lot of, as Lawrence keeps talking about, a lot of liquidity in this market. And so deals are never easy. The question is, are they more apt to be completed and closed? And I think the answer is yes. And I would say to management teams and to investors, again, remember I'm the matchmaker, hey, let's bring that inside bid a little tighter so we can get things done. More deals are better for our market, right? Less deals can shut down the market, right? And I'm talking about deals, again, outside of the crypto DATs, right? And I'm a big fan of them because they brought liquidity to the market.
And Lawrence made a great point earlier. The quality of the investors showing up in the microcap space has completely changed over the last 3-6 months.
Yeah, for sure.
Is that was the crypto side only?
No,
It's
I'm saying
not.
absent.
Yeah, it's
They're deploying capital.
it's
You're not
just-
getting the big deals.
You want to
being
add
done.
or you want to? Fair. All of those add to the liquidity in the market, and they bring awareness to the small cap. I define small cap as less than $1 billion. You can define micro cap as less than 100 million. Either way, there's more activity and more liquidity in the market. But I want to make a very strong differentiator. Your question is it easier? Never easier. It's always hard, right? It's always hard. As in the beginning, I said both sides rising. Rising tides lift all ships. But that means both sides of this equation rise. So I want a higher price. An investor wants a lower price, but everything's going up. So how do I make that delta work? In the end, deals promote liquidity, and that's capitalism 101, right? That's capital markets. We want that to be happening. To hopefully provide capital to management teams that can place more beer in more locations, more lasers in more locations. Yeah. Okay. All right. Now. Oh, laser etched glasses. Champagne glasses too get etched.
So obviously, states shut down. But what about for international listings? Instead of going to Peter Brockman, we went for Steve Dangle, and his Egger filings are still open. Obviously, 28 rules there, but obviously not going to get accelerated for effectiveness. But isn't that a viable route?
again, going back to, that's going to all depend on risk tolerance and where you were in the process beforehand, right? I don't think there's any real difference whether you're filing an F1 or an S1 for the most part. So it's just a matter of whether or not you've considered all the risks and where you were in your process when the government shut down, right? So if you're going out with a new filing now, you know, it's about risk profile and it's about whether the exchange will even allow you to do it, right? So they're coming out with their own rules now. I don't think New York will if it's a new filing, if it's a new issue. Again, if you had started the process before the shutdown, you only had a couple of comments left. I think Nasdaq will certainly consider it on a case-by-case basis.
Same thing with those $2 billion valuations or the $6 billion, 45 million, something like that valuations. These are the valuations. I think it's like Indian or something international side. There's another term out there. I can't think of it offhand.
I'm not.
Because of the egg are still open, I was thinking that you could. But yeah.
No, I mean, I think you're ultimately still subject to that, you know, whether or not you're going to use 8A, right? I don't think the valuation or the size of the company matters. This is everybody across the board that's having issues. Now, obviously, when you get into bulge brackets that are ASR eligible, they don't require review by the SEC. So if you can go automatically effective by filing, you know, an S3 ASR or an S8, you don't have any of these issues, right?
They wouldn't have an issue anyway, though. They would just need to file.
Yeah, they wouldn't have an issue.
Right.
It's not subject to SEC review, right? So if you're
But-
WIXI status and you can file an S3 ASR,
But
you
all-
can do deals.
But all the law firms and the banks involved and everyone would make sure that everything would be done. There's no like lackadaisical. stuff
No,
that's
no,
going
you have
on,
to make
right?
sure, obviously,
Yeah,
that you're
yeah,
WIXI, right? I mean, you have to make sure that you meet the standards to file that way. So again, you're seeing most of these issues affect our space, right? The microcap and small cap, because they're typically not WIXIs, right? Some of the companies that have done that strategies recently are, and now file S3 ASRs. But for the predominantly, you know, microcap doesn't have many WIXIs, which is, you know, being over a 700 million non-affiliate market cap, right? That's
So
that's
the
certainly.
reason why these larger tier 1 firms are coming down and getting some microcaps and taking advantage of this time.
Again, that I think depends mostly on liquidity and just doing deals, right? So, you answered.
I don't think-
you
I don't
asked a
thi-
separate question, but I want to bifurcate your question a little bit, right? Because there's secondaries and then there's IPOs in the small cap space, right? The IPO and especially domestic IPOs in the microcap space have not gotten any easier. Okay, at all. That's not what the data reflects. I think what I think what people are not really apt at gleaning from the data is the fact that it's not that the deals went away. There's actually been a tremendous amount of deals. The check sizes got smaller over the last few years, right? So you started seeing IPOs getting done at, you know, basically $7 million was your median capital raise. That now has been challenged by the change in the Nasdaq rules in April, right? Because you can no longer use selling stockholder tables to meet the requirements for the public float, right? So what we haven't yet seen, because, you know, those rules got changed in April, it coincided with the crypto boom, right? So people got caught up in the sort of the crypto boom, and there's been 150 DAT deals in the space, ultimately, which is predominantly all microcap because you can't make NAV work with a huge, you know, public company. So there hasn't necessarily been a focus on what's going on with those domestic IPOs and what's going to happen once those rules have a full 24-month to hit. And, you know, ultimately, looking at better quality companies need to concentrate on capital raise that are.
But basically, a lot of those factors, this is a company, Nasdaq company, just couldn't raise money. Right? They have an asset, they have a Nasdaq company, their business doesn't merit the $5, $7, $10 million in the raise, so they had to find something to put in there as an asset to create some kind of capital raise, because all due respect, there's no capital raise out there for these companies out there.
That being said, what Lawrence just said is what Nasdaq and the NYSE, who will follow suit, is saying is, I don't know if the word's a better company, like it's just
Stronger fundamentals.
stronger fundamentals, all of that, right? And that being said, that's not bad for anyone in this room. It's like, okay, if we need to bake another year so we can raise 15 million, okay, let's do it.
are we just creating a SPAC in a public company now? But creating these things, and that's in there, and then, because that's really in there.
Well, you're talking about DATS specifically.
Yeah.
Oh, we're not talking about DATS in this conversation. We're talking about, no offense, beer companies, Rebel brand. We're talking about we're talking about a not a DAT strategy. If you want to talk about DAT strategies, no. And I mean, we can, but that's something completely different. And I think, look, not to be off topic, but my partner, Matt, who's sitting back there, we talk all the time about how did DAT strategies, we talked about it with you, Lawrence, how did they come about? Was someone drinking a shit ton of, Rebel beer? And they said, how did this, what if we do this? And how do we take advantage of this listing? How do we take advantage of the crypto headwinds worldwide on the ability, even though there's a DeFi model in place, it's so hard for those folks. And even if you're in the US, if I'm in New York State, I can't trade crypto, right? But I could buy a stock on Nasdaq that effectively trades crypto, right? So who thought of that? Not who, but how did someone talk to a legal advisor like Lawrence? I'm not saying you did it. Maybe you were the creator of it?
I think
his firm did the
I've given him the option to say
I think we may have done the first one. It's possible.
But
outside of
to say, hey, here's a pathway forward. That being said, I'm all for it. I love it, but I don't think that's this discussion is more. It's an open discussion, but it's more about, I think what Lawrence was saying is about traditional operating businesses, right? What is that business going to take to list on Nasdaq or eventually the NYSE? And those fundamentals being improved or needing to be improved to garner a larger IPO minimum, I'm a fan of it. Hey, I'm the banker, right? If we got to raise 15 million instead of, 5, 10, it makes me more money. So that's good. It won't be easier.
Can I switch the
Please.
topic a little bit?
Yes, I apologize.
Yeah, a little bit on your business.
Yep.
As well too, but for you guys to answer. As an investor, as sometimes board member, strategic advisor, talked into management at various different companies, private, on the way to be public, or whatever they are. Speaking to you in your particular business,
Yep.
I recommend almost to every private company or public company that they hire a firm like yours to
Sure.
go along with the auditors.
Yep.
Because we dealt with what happened with Commissioner Williams in the PCOB cycle for the last couple of years. We dealt with the different auditors and the different
Yep.
sizes out there, the lack of people in that particular industry, the delays coming through. I mean, that's the other part of the challenge to get through there. So my question would be for you guys. I mean, I don't talk to a company, and I talk to tons of them that I don't end up working with or whatever, that I don't recommend
Right.
service like yours guys all the time. I think it's incredibly important for these particular
So,
companies. And it just makes a higher quality deal as you're going through. It helps your auditors, it helps you get through those things. So you're not
It helps your CFO. So I think the hardest thing in the microcap world is the CFO has to wear so many hats. A lot of companies, it's the CFO, and he's also the bookkeeper. He's also the controller. He's the but they don't have the skill. They don't have all of the skill sets to do it all. So a firm like mine, we can plug and play to help that CFO with everything that he's not strong at, right? So that's where I get a lot of referrals from these gentlemen.
You guys, I mean, again, I don't recommend any company that
Sure.
I talk to. I've talked to you guys, and another you guys are representing them. IPO getting ready to go small nuclear company. I'm like, guys, you have to find a third party group to go along with their place your CFO to augment this as you go through the process. Even when you have it, it's not a need to have, it's not a nice to have, it's essential to have. And the auditors love it. They love to have that in between because you write memos and different things. So any management, if you're still in the room or whatever, my question is I couldn't imagine any company not going through that unless they just had a really seasoned team and they're a little bit higher tier.
That's a great, as David knows, and I'm a very large referral source for David, ultimately over the last, and our firm has been for the last 14 years. The one of the biggest steps, period, for a lot of these private companies going public is getting an audit done. And ultimately, I don't think that they realize just how difficult that is once they hand in their work papers that are so deficient. Right. And so everybody comes to me and is like, yeah, the audit's no problem. We're going to be done in 6 weeks. I'm like, have you actually spoken to the auditor or handed them anything? And that's always my first question. That's why, because I know, and it's not because, right. And, again, that's just, that's been our experience a lot of the times. And it's not because they don't know what they're doing. It is because they just don't have the resources to do everything. And a lot of times, especially when you're doing it for the first time going public, it's a totally different animal, right? So we always recommend, an outsourced group to be the CFO's best friend, ultimately. Take that off their plate. It's usually very cost effective and ultimately saves you time because the back and forth with the auditors is reduced substantially because they get everything in a nice bow. And now you really do get that 6 to 8 week timeline instead of a 12-week timeline.
We'll push you leveraging expertise that this
Sure.
firm has across like
Exactly.
companies as well, dealing with you guys too, instead of, three accountants in,
Yeah.
Wyoming, like in a
Right.
box.
Oh, yeah.
I
Or
think-
overseas. I mean, a lot of these
Yeah.
firms are.
And I think one of the biggest things here and going public or becoming public is an egotistical process, right? Usually you have a large shareholder, a CEO, not a CFO, CEO or a founder that's egotistical and they want to go public. And that's great because that ego promotes their business. Usually there's someone left to clean everything up. And as you mentioned, it's usually a controller or a bookkeeper. It's not a CFO because they were never intended to be that person. And then it gets very, quote expensive. So people are like, oh, we can't pay Dave $1 million. No, I'm joking. I don't think it's $1 million. But whatever it is, whatever you pay, Dave, is going to save so much money in the future in that delay and back and forth with company counsel trying to draft the S1 or any of those financial statements incorporating. But if you've never done it before and don't know it, then there's you need a strong board or someone like yourself that would tell that board, hey, no, you're hiring Dave because we're not dealing with this. I've been through this 3 times. It is invaluable. Every time we do a transaction, the auditors are always the delay. Always. That's why I looked around.
This isn't being recorded, is it?
And it's fine. But the caveat is, to be fair to this conversation, your question, it's not the auditor's fault.
No.
It may be the company's challenge of producing and not knowing what the auditors need, right? Like, it's the same old thing. Imagine, you have to audit your own life. Hey, you went to that gas station, bought $10 of gas. Do you have the cash receipt you paid for that? What? The auditors are going to ask for that at some point. Maybe not $10 cash receipt, but at some point. Yeah, some auditors. That's fair. So I would highly recommend Dave and all of those groups, right? They only help.
Okay, one more comment, and just can you comment on kind of where Reg A's are like right now, and the maturity, like where that is, like going forward. Again, we've all been distracted. We've been called again as board member, advisor, management to do crypto strategy, treasury strategy, flip the companies, do this, maybe allow them mature, whatever that's going to be. But again, Reg A's been out there as a job back, matured.
Yep.
They're all over the place right now. They're working. I think a lot of them are working. But any comments on kind of where they are?
Yeah, I'll jump in because I've got 2 in the office right now. They are starting to work. And it really comes down to, does the business have an affinity group? If there's an affinity group behind a customer base, you guys, to me, that could be a potential. Yeah, interesting. But yes, But yeah, so those are the ones that you're seeing getting done, and they're very successful.
Yeah, funny enough, I was not a huge proponent of Reg A when it first came out. There were obviously some glitches and some problems, right? Everyone remembers some of the first deals, and then of course the Nasdaq halt, right? Because I think companies were playing a little bit fast and loose with the valuations, right? Because there was no banker. They were raising capital, and then they would list on an exchange, and the funds would immediately come and eat their lunch, right? And they were immediately cut in half, and Nasdaq put a pause on some of those IPOs a few years ago. Since then, I think you're right. The market has matured substantially, and I also 100% agree with David. In my opinion, and this is just an opinion, the Reg A's that are successful and that you're seeing get done are ones that already have built-in brand and customers, right? And that's even from the very beginning, right? I believe it was Kathy Ireland's company that went.
The wine company?
No, it was a furniture company that went public, right? That was
How many
one of the
companies
first
can she
Reg A's,
have?
and that's because they had an email list of 100,000 customers that they could use, right? So you have Newsmax now, which is obviously now one of the largest success stories in the Reg A space, right? Again, built-in user base, right? 1 million people watching it, huge database, huge people that are very, very large fans of the brand. And when you have 1 million people, even if they're investing a few $100s, it's a lot of money, right? So that works for those types of companies. Where it tends not to work, and where, again, my opinion is that it's probably not as useful, is in more technical cases that MAPA kettle don't really understand or can't get behind, right? If you're selling a bicycle and it's a cool bicycle, everybody knows what that is. If you're a biotech and you're trying to explain to people on the street what this molecule might do in 10 years, I don't know that that's necessarily going to be their cup of tea, right? So I think that there is definitely a segment where this works for Reg A, and you're certainly seeing it, especially as retail investing has exploded since COVID. But I think when you don't have that brand awareness, the Reg A's also become very expensive because you're spending so much money on marketing dollars. You have to figure out what your funnel is, what your cost of acquisition per customer is, and it might not be worth it for a small company.
I'll only say one thing on that, is there is another aspect of Reg A's that we can talk about after. There's a very interesting play that's happened recently in Reg A's, and you don't need an affinity group for it.
Any other questions?
For Lawrence, first I just want to say that we use Joe Lukowski and your firm for all of our heavy lifting at American Rebel, and I just want to say thank you for the great job you guys do.
No, I appreciate that. Thank you.